Welcome to our presentation on financial reform in China. Investopedia defines finance as, quote, the science that describes the management, creation, and study of money, banking, credit, investments, assets, and liabilities. Financial systems were developed as a means to create structure to barter and bartering systems. All financial systems have three specific genres of public, private, and government institutions. China is no different than any other emerging country in today's fiscal marketplace. In order for China to orchestrate and establish a means to succeed, a stable financial system must emerge. This presentation will look at past and present financial development so that we can see where China has been and where it is heading. China's growth, development, and emergence as one of the largest financial global resources comes from years of trials and tribulations. Before any banking systems emerged, pawnshops, money shops, and mutual savings associations were local providers of credit services. In the late 1800s, there were interregional banks called piahao. And this began one of the most crucial time periods of financial growth developed between the 1870 and 1930. And this was the time frame to which family-owned enterprises transitioned into private equity ventures in hopes of channeling domestic and foreign savings through bond and stock markets. Growth rates for foreign investment grew substantially between 1870 to 1930. Some would say that this growth came with a price, being that China did not allot themselves full control over the government finances to which foreign investors had the rights to. And various hostilities towards this emerged among the people and sparked a revolution in 1949. After this revolution, there was gained momentum towards China's capitalistic market. Originally under the official supervision and merchant management, various entrepreneurs sprouted up in the early 1870s to 1880. Areas that were affected by this or companies were the Imperial Telegraph Administration, Haoxing Textile Mill in Shanghai, and the Imperial Bank of China. Because this left China without official exchange of securities, they introduced an organization called Guangsheng Heban, and China sought out government involvement via the company law passed in 1904. This allowed for indirect regulations and shareholder protection to emerge, along with the development of a public securities market. The first boom in the stock market occurred in the 1880s, where the stock prices escalated above par value. However, this peak was short-lived. Shortly after, the Shanghai market crashed in the mid-1880s. Even though this was a very short period of growth, it sparked the interest of investors, including that of foreign investments. During the Taiping Rebellion of the 1850s through 1860s and the Muslim Rebellion of the 1870s, there was an urgency for expansion of Chinese commerce in order for cash to float around the country to support its government's needs. These urgencies were the driver for those interregional banking services to emerge. Shanghai banks would then serve as lenders to smaller localized banks as means to develop this interregional banking structure. However, this did not seem to be enough for growth to develop quickly. And this being the case, the Chinese government sought out foreign loans. The Taiping Rebellion showcased the need for paper money and a large deficit in China's finances. With that, Shu Han, the local governor of Qingshu, received permission to borrow 300,000 taels from foreign merchants. This loan was solidified and assured by vouchers. Loans occurred from 1862, 1864, and 1866 in order to support the military, and this era was noted for its emergence of government revenue via loans from foreign merchants, which then aligned with the emergence of maritime custom receipts. In correlation to the Taiping Rebellion, the next government loan emerged in Taiwan in 1874 to support the military against the Japanese. In 1877 came the emergence of the first government bond of 5 million tael, also known as the loan in silver. This is important because not only was this the emergence of bonds, but also the emergence of the international capital markets. And soon throughout the 19th century, larger bonds emerged, which required international banking syndicates. Overall, this was a critical area of development for both government support as well as fiscal allegiance with foreign investors. With the emergence of the new government and Chinese mentality, Great Britain, Germany, France, Russia, Belgium, and Japan all began negotiations with China. Loan rates during this time ranged from 6% or higher up until about 1919 when a shift in the regional power and alliances happened, which made for uncertain finances. In fact, on October 19th, 1921, China defaulted on various loans and was forced to declare bankruptcy. Throughout this tumultuous time, however, the 1898 Anglo-German loan and the 1913 reorganization loan, those were the only loans China paid during this time. Most external loans made with China defaulted. Then the Great Depression, along with the devaluation of silver and a surge of natural disasters, ruined China's ability to borrow from external investors. This spurred the alliance known as the Internal Debt Bureau, established by the Chinese Republic. This only led to more default on domestic and foreign loans. And the Nanjing government soon had to step in the early 1920s to restructure the yield on the domestic loans, which were from 7 to 8%, restructuring them down to 6%. This was then extended throughout to 1937, where there was another need for domestic bonds due to the Sino-Japanese War. This time, instead of China turning to foreign investors, they turned to local banks. Due to this, regular taxes and custom revenues decreased. Eventually, this led to the currency reform of 1948, which issued currency at a rate of 3 million to 1 and would eventually eliminate existing domestic debt. Over the duration of the last 20 years, China has established special economic zones, also known as SEZs, which are comprised of both foreign and Chinese-owned ventures that work in unison that make up China's joint financial institution. What's unique about China's financial system is that it enlists the help of various foreign investors. And some of the largest global banks are found within the boundaries of China. In 2004, total assets of foreign financial institutions were equivalent to over $47 billion in assets, which can be found spread out throughout the 211 various foreign bank branches in China. Because foreign-owned banks expanded their various China-related business, the China Banking Regulatory Commission, or CBRC, was developed and established to implement various new policies. Such policies elaborate on the regulations surrounding foreign banks and the territory to which they may be implemented in. New policies have also encouraged international investment that will then help restructure China's banking systems and overall financial institutions. In fact, at the forefront of these institutions is the Bank of China, one of the largest international banks, which overlooks various overseas investments. In fact, the International Monetary Fund has accepted China's renminbi currency, which recognizes the reforms China has made. China's underlying goal of financial development comes from its pursuit of social reform and in becoming a well-balanced society. By creating growth of the country's GDP, China hopes to spread overall profit more evenly among its citizens. Through various reform-driven actions, China has built the second largest economy by 2005, with hopes of quadrupling this amount by 2020. China must follow and abide by its financial goal-driven mentality. Most of these goals are attained by 5-year plans and various planning measures that have been set in place and have prevailed since 1978. These ideals have grown due to the socialist market economy with Chinese characteristics. The focus of these characteristics surrounds the state-owned industrial assets. Technological advancements and the large-scale growth of China's industrialized lifestyle have allowed for China to stand tall amongst many within the realm of international trade. Today, China has a wide range of financial institutions, from banks to security companies. A simple but useful measure often used to illustrate financial deepening is the proportion of money supply to GDP, which is shown here in this graphic, and it rose from 32% in 1978 to 178% in 2009. Similarly, the proportion of financial assets to GDP increased from 51% to 200% during the same time period. These latest numbers were among the highest in the world. In fact, China is on track to equal the US GDP by 2025, as shown in this graphic. Thank you for watching. I hope you enjoyed.